Hey everyone, if you're following my channel, you would know that one sector that I like the most is IT sector. It is part of my core portfolio and has generated great returns over the last few years. Now historically, IT sector has been one of the biggest wealth creators, but there's a sharp correction in the last few months where the entire index has corrected 13-14%. And this correction is quite brutal at individual stock level. For instance, Sonata Software is down 39% from 52-week high. Coforge is down 31%, then Birlasoft is down 28%, Cyient is down 28%, L&T Mindtree down 35%, Persistent System down 21%, Intellect Design is down 25%, HCL Tech is down 21%, Mphasis is down 32%. Happiest Mind is still down 45% from its all-time high. Then even EV software companies have corrected significantly. Tata Elxsi is down 30% from its peak, L&T Technology is down around 25%, Tata Technology is down 25% from its listing price, although KPIT is in a different league altogether with exceptional performance, but it is also down around 14% from its peak. I also like one more company in this space, R System, which is also down 20% from the peak. Only IT or rather software company that is trading near all-time high is Newgen Software. Now I was going through the IT index pattern and identified something very interesting. Over the last 5 years, IT index created massive return during COVID period between FY21 and 22. Index jumped more than 200%. Then FY23 witnessed sharp correction and many companies tanked badly. Again, FY24 was a good period where IT sector created wealth for the investor. And now FY25 has started on negative note. If you observe, FY23 correction was a golden opportunity to accumulate IT companies at lower valuations. Question is, can FY25 create similar investment opportunities? So in this video, I would help you understand why IT sector has been a wealth creator and more importantly, why it has corrected sharply in last few months. And then we'll try to understand if there is more pain ahead or worse is over, so that we can decide if it is time to add IT stocks or wait for better opportunities. But before we begin, just a disclaimer that this video is only for education purpose. Please do your own research before investing your money with conviction. Alright, let's get started. The biggest reason why I like to keep IT stocks in my core portfolio for long-term wealth creation is because of their business model. Indian companies are world leader due to availability of talent at very low cost as compared to developed countries. As a result, top global MNCs outsource IT work to India. Moreover, IT companies operate on a good margin with high profitability. Since majority of business come from US and European market and majority of expenses are in Indian rupee, this has resulted in excellent margins for IT companies. On top of this, IT companies have a relatively asset-light model as compared to other sectors. The biggest expense is employee cost. Hence, IT companies have generated huge cash from business. As a result, many IT companies are also giving good dividends. On top of that, IT companies have negligible debt. All these factors make them a strong wealth creator. And as far as future is concerned, future is digital. There is no sector today that does not need IT support. In fact, IT has now moved from just a support system to a part of strategic investment where companies are investing in advanced technologies like artificial intelligence, IoT, cloud computing, advanced analytics, blockchain to ensure that they stay ahead of the curve. In fact, this is almost a sanity now. If a company does not invest in new technologies, it can be wiped out of the market. So IT role would only become more important over time. Now these days there's a lot of concern around the impact of AI on the IT sector. Many people expect that AI would eat IT jobs. However, I strongly believe that AI will only create new job opportunities. Yes, many redundant jobs would be eliminated, but there will be new opportunities. So I don't see AI as a threat for IT sector. In fact, it's a huge opportunity and every top IT company is investing heavily in developing AI capability. So in my opinion, IT companies are fundamentally strong with bright future prospect. So they would continue to create wealth. The only question here is valuation. At what price do you want to buy IT companies? This is going to be the single most important parameter. Let's discuss it in detail. Okay, before we discuss the IT company's valuation, let us quickly discuss how a stock creates multi-bagger returns. This would help you understand how to decide valuation of IT companies. So there are two key parameters that decide how much return a stock can generate. First is EPS, that is earning per share, and second is valuation. Now let's say there's a company ABC with earning per share of 50 rupee and current market price of 750. So its P ratio would be 750 by 150, that is 15. Now let's say company's earning per share has increased from 50 rupee to 100. It means earnings have doubled. Now ideally the stock price should also reflect that and stock should double. But here valuation plays a key role. Let's say market value the company at same PE of 15. In that case, its share price would become 15 into 100, that is 1500. Very simple. But what if market decide to value the company at PE of 30? In that case, valuation has expanded 2 times and earnings have also expanded 2 times. So now the share price would become 30 into 100, that is 3000. So here the stock has generated 4 times return. Now let's assume company is already trading at PE of 40 with EPS of 50 rupee per share. So current market price would be 2000. Now if EPS grows from 50 to 100 but market decide to value the company at PE of 30, then company share price would be 3000. Can you see the difference? In spite of 100% growth in earning, share price has only grown 50% because valuation were already at higher side of 40 and market decided to give a PE of 30. So at the end of the day, earnings growth is very important, but at the same time, valuations are equally important. If you invest in a company with higher earning growth, but valuations are also high, the return potential is limited as there are chance of valuation derating if earning growth slow down. The best scenario is to identify companies where earning growth is good and PE is also low. That gives a scope for valuation re-rating. So when earning grows and PE also expands, share price grows more. Although it's very difficult to get such stocks during a bull run. So when earnings are expanding, market would give a premium valuation to the company. And this valuation increases multiple times during the bull run due to euphoria that makes the stock expensive. But the opportunity is when earning growth falls temporarily due to external reason and market gives a low PE to the company. Eventually when the earning growth would increase, market would give a higher PE. In fact, this is exactly the reason why PSU banks, defense companies, capital good companies, even solar companies today have outperformed. They commanded very cheap valuation a couple of years ago, but when their earnings expanded, valuations also improved and that resulted in multi-bagger returns. Now let us come back to our IT sector discussion and why earning growth and valuations are very important. For example, during COVID period, IT companies' earning growth expanded big time due to high demand for digitization and lower cost as travel was banned, which is a significant cost for IT companies. Due to that, IT companies' EPS expanded big time. And since the sentiment for IT companies were very strong, PE also expanded. So both EPS went up and PE went up, and that resulted in multi-bagger returns for IT companies. And Happiest Mind is a great example. So it launched its IPO in September 28 rupees 166. During IPO, Happiest Mind PE was just 20 and its FY21 EPS was 11. Then over the next 2 years, company's EPS expanded to 15.7. So that's around 40% earning growth. But company's PE ratio zoomed from 20 to 140 because of euphoria. So 7 times growth in PE and 40% growth in EPS resulted in 10 times growth in share price. But eventually Happiest Mind earning growth reduced due to slowdown in US and was almost flat in last 1 year. But its PE ratio fell down from peak of 140 to now at 52. So this 45% correction in Happiest Mind from its peak is because of PE contraction. Then another great example is Newgen. Company share price tanked 50% in calendar year 2022 and its PE ratio fell down to very low levels of 16. Now in last 1.5 years, Newgen EPS has grown 50%, but its PE has expanded from 16 to 58, which is 3.6 times. Hence its share price has grown 5.4 times in last 1.5 years. The moral of the story is you need to invest in IT companies at lower valuation to really enjoy the growth in the share price. Now obviously you won't get the low valuation when the news is good. And that is the reason majority of IT companies were trading at expensive valuation. However, due to weak result, IT companies have corrected in the range of 20 to 35% and valuations are now looking slightly better. Please note that the weak results are because of slowdown in the US market, which is the primary source of revenue for IT companies. And this is a temporary correction due to slowdown in IT and tech spending due to very high interest rate. So these IT companies are still fundamentally strong. Eventually, when the interest rate would start falling, US companies would increase their IT spending and IT companies' EPS would again grow and then valuations will be re-rated. Now let us look at the current valuation of IT companies and compare it with its peak and median valuation to understand where does valuation stand as of today. So this Excel sheet represents the 25 IT companies that I've been tracking, and you can see there is a market cap, current market price, PE ratio. Then I've identified the peak PE of these IT companies and what is the percentage correction. Then I've identified the median PE of these companies for 5 years and percentage change, then all-time high share price and percentage change. And currently this is sorted in terms of market cap, Now, if let's say you want to identify companies that have corrected the most, then you can just sort it. So you can see Happiest Mind is still down 45% from its peak. Sonata Software is down 38.45%. Wipro is down 35%. L&T Mindtree 35%. Mphasis 31%. Coforge 30%. Saxoft 30%. Then Latent View nearly 30%. The lowest correction is in Newgen and Zensar. Now here, if you look at the PE ratio, so basically your current PE is shown here, and you can see the peak PE and the correction in PE. Let me just sort it in terms of lowest to highest to lowest. That will give you a good idea. So Intellect Design once commanded a PE of 137. Today its PE is 37.8. Now obviously this was a crazy valuation, and from there PE is corrected 72.46%. Its 5-year median PE that gives a better picture, which is 31.6, and currently it is still above its 5-year median, but yeah, there's a very good correction in its valuation. Share is down 25% overall. So this gives you a very good idea in terms of how much PE has corrected, and what is the percentage change from median. Now this is very, very important, because ideally you want the PE ratio to be near its median PE. So if I just sort it in terms of your percentage change from median, you can see Infosys 5-year median is 26.4 and its current PE is 22.8. So current PE is already down 13.6% from its 5-year median, and as compared to peak, it's down 40.6%. Likewise, L&T Technology median PE for 5 years is 37.6 and today it is at 36.2. Likewise, Tata Technology median is 58.9, today it is at 57. Right? So this gives you a good idea in terms of which companies are now trading near their median PE. Here, please note that you can't just look at Tata Elxsi PE of 57.5 or let's say KPIT PE of 69.8 and compare it with let's say TCS PE of 30. So basically KPIT commands a 69.8 PE because it is giving a stellar performance quarter on quarter, and its EPS is growing at an exponential rate. So it will command a premium. Right? So you can't compare KPIT with your TCS, or let's say you can't compare Tata Technology PE with Infosys or TCS. So every company would have its own EPS growth trajectory and would command a separate PE. Ideally, if you want to compare the one of the ways, obviously you compare the companies together in large cap space. So you can see here, these are the large cap companies, and they've got similar PE ratio. Then ideal way, in my opinion, is to look at the median PE. That gives you a better picture. And like I said, a lot of these companies have already corrected and now trading near the median PE. Another 10-15% correction in the IT stocks would make the valuations even better and close to the median PE, and would make these IT companies very, very attractive. Clearly, the valuation analysis suggests that IT companies' valuations have corrected significantly from the peak, and many of them are trading slightly above the 5-year median PE. So valuation for majority of companies are looking decent. Still, another 10-15% correction in FY25 would make IT companies very attractive. And since US market is facing a slowdown due to higher interest rate, the management commentary from IT companies is not very encouraging for the year of FY25. And that's the reason I believe that there's a scope for further correction in PE ratio in the coming months. So another 10-15% correction in IT companies would create great investment opportunity for long-term wealth creation, because eventually US market would recover, especially after the fall in interest rate, and that's where US companies would increase their IT and tech spending, which would directly benefit IT companies and increase their EPS. I think the moment US rate cuts would start, which is expected by the end of this year, IT company share price would again jump. That's why IT companies are my biggest contra bet for FY25. Now today IT sector is technically in downtrend, but nobody knows the exact bottom. So you have two options. First is, if you can time the entry at better levels before the situation improves, then you can wait. Second option is, if you can't time the entry, which is the case with majority of people, the better approach would be to consider adding IT companies systematically in FY25 starting now. Please note that since entire IT sector is in downtrend due to negative sentiment, it will test your patience. You might feel like selling IT stocks and buying hot stocks that are rising every day. But it is difficult times like this that would create buying opportunity in IT sector for long-term wealth creation. It won't be easy. You would need patience and conviction, but like I always say in stock market, your patience would be tested and conviction would be rewarded. In case you are confused about picking the right companies, you can even consider investing in the entire IT index. But in that case, you will have more allocation in large caps. If you want to know where I am investing my money, you can explore my weekly video series that include one exclusive video every week. Details you can get from my website or from the join button. So in this video, we discussed why IT companies are wealth creators in the past and why they would continue to create wealth. We also discussed the reason behind the fall in share price, and due to correction, P ratios also corrected from the peak and now trading close to their median P, still slightly above the median. Another 10-15% correction and P would be similar to median P, making it attractive for investment. As I mentioned, once interest rate would start falling in US, tech spending should increase and IT companies' earning would improve. Hence, this correction in FY25 is looking attractive to consider investing in IT sector for long-term wealth creation. Now tell me in the comments, what is your take on IT sector? Are you investing or waiting for more correction? If you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.